Something is building in precious metals, and it isn't showing up as a clean headline or a single signal candle. It's showing up in the relationships underneath the charts, especially the gold to silver ratio. And when long-running relationships break, price doesn't move politely, it reprices fast. Francis Hunt's core warning is simple. The gold to silver ratio has been unnaturally stretched for years, keeping silver cheap relative to gold. Not a little undervalued, distorted. Distortions can last, but when they reverse, they often reverse violently. This ratio is the key because it removes emotion. Silver can feel expensive just because it's higher than it was. But the ratio asks a tougher question. Is silver expensive compared to gold, or is it still in catch-up mode? If the ratio falls, silver must rise faster than gold. That's math, not a story. And if the ratio falls into levels the modern crowd isn't psychologically prepared for, silver's implied price becomes uncomfortable to say out loud. That discomfort is exactly what late cycle markets feed on. People keep missing bull moves because they ask the wrong question. Is it too late? That's usually fear wearing a suit. The better question is, what phase are we in? Early phases feel uncertain and underowned. Late phases feel obvious and crowded. If you're still seeing constant skepticism, constant "this can't last," and people waiting for a perfect pullback, that's usually not a top. That's still disbelief. Disbelief means positioning is incomplete. Incomplete positioning is how you get violent upside when the market forces people to chase. Hunt calls this contagion, a phase where a move stops being orderly and starts feeding on itself. Relative value players pile in. Macro allocators adjust. And silver, because it's smaller, more volatile, more emotional than gold, turns into a crowd event. Silver doesn't drift into mania. It snaps into it. That's why early signals matter more than late headlines. Wait for mainstream confirmation and you'll feel safer, but your risk will be higher because the price will already have moved. This is the uncomfortable takeaway. You don't need everyone to agree. You need the ratio to keep breaking down and silver to keep outperforming. Once that happens, the conversation shifts from should I buy to how do I hold? And holding, mentally, is the hardest part. Because the biggest money usually arrives late in a short window, right when everything looks ridiculous and every instinct tells you to lock gains. That S where this goes next, how parabolic moves actually work and why most people sell before the real acceleration. If this develops the way Hunt suggests, the real challenge won't be spotting it. It'll be surviving it emotionally. Parabolic markets don't reward intelligence as much as they reward discipline. Hunt S, law of the parabola, is brutal. The final stretch often delivers a disproportionate share of the gains. And that final stretch is when people sell because prices look insane and pullbacks feel deadly. Silver is famous for violent pullbacks. These aren't bugs, they're features. Silver shakes out weak hands, clears leverage, triggers stop clusters, then runs again. This is not conspiracy, it's mechanics. Stop losses cluster because people cluster their decisions. Markets move into clusters because that's where liquidity sits. So the wrong approach is waiting for one perfect entry or one perfect exit. That mindset creates two outcomes, doing nothing or chasing at the worst moment. Hunt's practical fix is multi-time frame thinking, not to sound sophisticated, just to stop your brain from getting trapped by the biggest chart. Zoomed out, silver looks like a straight line and feels too late. Zoomed in, you see micro pullbacks and re-entry windows inside a larger trend. Those windows rarely feel comfortable. They look like weakness. They arrive when people get quiet. They arrive when the crowd says the move is over. But those moments often offer the cleanest risk definition. You can place a line in the sand and let the trend do the heavy lifting. That's the key difference between amateurs and pros. Amateurs ask, is it too late? Pros ask, where's my next controlled entry? And when the move gets chaotic, pros don't panic because they expected chaos. They planned for it ahead of time. The other trap is selling based on price alone. Sell at $100, $150, $200 because it feels high, and you risk missing the final squeeze. Hunt's focus is behavioral and relational. What is the ratio doing? What are the pullbacks doing? What is the crowd doing? Late cycle tops don't feel like quiet satisfaction. They feel like mass conviction. Everyone becomes a believer, premiums spike, availability tightens, and the news starts sounding like a movie trailer. That's when you manage exits intelligently, often scaling, not dumping everything. Because the end phase can be fast and violent in both directions. The point isn't to predict the exact top. The point is to avoid the most common failure, selling early. Because the chart looks scary, then buying back higher because regret becomes unbearable. If the ratio keeps collapsing, the risk isn't that silver can't go higher. The risk is that you won how do you hold through the volatility that comes right before the real acceleration. Now here is the part that takes this from interesting to uncomfortable: supply. Silver is not like a product where higher prices instantly create more output. A huge portion of global silver comes as a byproduct of other mining: copper, zinc, lead. That means silver supply does not simply ramp because silver is hot. A copper mine doesn't double output because silver hits a new level. Silver is incidental, so you get a structural constraint. Supply is sluggish even when price screams produce more. Now combine that with demand that doesn't politely pause. Solar keeps scaling, electronics stays sticky, defense and advanced manufacturing don't wait for a calmer futures curve. And then you add the next wave that Hunt highlights, new battery technology, especially solid-state concepts. If even a portion of that scales, the silver requirement can become enormous, large enough to collide with current production in ways the market is not priced for. The world doesn't need to run out of silver for repricing to happen. It only needs the next available ounce to be harder to source at the exact moment it is needed. Markets reprice scarcity at the margin first. That shows up as premiums, lead times, and tightness, not always in the headline spot price immediately. And when physical tightness and paper liquidity diverge, you get a dangerous setup. Paper can look plentiful. Physical can feel scarce. That, yes, when price discovery can turn violent because paper markets try to catch up all at once. When people hear shortage, they imagine an instant empty shelf. Reality is quieter at first. It starts as friction. Higher premiums in certain regions, longer delivery windows, more aggressive procurement behavior from industrial buyers who decide a few extra weeks of inventory is worth it because disruption risk is rising. These are not dramatic moves. They're prudent moves. But when many participants act prudently together, the market tightens fast. Another underappreciated point, holding silver is balance sheet expensive. It takes space, financing, and compliance. As financing gets more selective, fewer players want to warehouse metal. That reduces the system's shock absorbers. So when demand surges, there are fewer stabilizers willing to step in. That doesn't guarantee an explosion. It increases sensitivity, and sensitive markets don't need big triggers. Small triggers create outsized moves. That's why you can get a sudden vertical move that looks irrational, but it's actually structure snapping into a new price regime. And once the crowd realizes the structure changed, psychology takes over, availability becomes the story, and the story becomes the fuel. This is where the market becomes more about behavior than about numbers. People love arguing about targets, $200, $300, $500, but targets are symbols. What matters is the path, how fast it moves, how it pulls back, and whether the ratio keeps confirming outperformance. Hunt's warning is not buy and pray. It's understand the cycle. Cycles breathe. They surge, pause, pull back, then surge again. If you understand that, you stop waiting for a perfect moment and start thinking in layers. Re-entry opportunities exist even inside powerful trends, but you only see them if you are re-watching the right time frame and you not emotionally anchored to the last price you wish you bought. One of the biggest mistakes investors make is thinking there's only one chance. One perfect entry that comes and goes forever. That's how you freeze. Hunt's approach is the opposite. Zoom in, look for controlled pullbacks, define risk, and let the trend work. Then, as price rises, you adjust stops, reduce risk, and avoid panic decisions. This isn't flashy. It's survival. And survival is what gets you to the parabolic phase where the market does the unbelievable part. At the same time, he keeps bringing the conversation back to the ratio for exits too, not spot price. If the ratio collapses into extreme territory, that's when the endgame begins. And endgames are messy. They include sharp reversals, sudden spikes, and emotional headlines that push people into rushed decisions. This is why scaling out often beats all or nothing behavior. Amateurs want a perfect top. Pros want a process. They lock some gains, remove emotional pressure, and let the rest run. Because in parabolic markets, you can be right and still fail by exiting too early or by re-entering too late. The other point Hunt makes indirectly is even darker. If silver goes truly parabolic, it's not because everything is healthy. It's because something broke in trust or scarcity or currency meaning. That's why he questions what the word dollar will even mean by the end of such a move. If the unit of account is degrading, hard assets can look like they're going up, but part of that is the currency going down. That framing matters because it changes how you think about profit, purchasing power, and timing. In other words, the move might not feel like a normal investment win. It might feel like a system repricing. And system repricings don't end neatly. They end suddenly. So where does this leave you right now? Not with certainty, but with a map. The map says, watch the ratio, watch the pullbacks, watch the market's behavior under stress. If the ratio continues to compress and silver continues to outperform, the bigger move is still alive. If supply constraints tighten while demand remains stubborn, sensitivity increases. And in sensitive markets, small triggers create big consequences. The biggest danger is not being wrong on direction. The biggest danger is underestimating complexity and overreacting to volatility. Silver will try to shake you out. It will drop hard, then recover, then drop again. That's how it tests conviction. And the test isn't about intelligence, it's about temperament. Hunt's message is basically this: the setup isn't finished and the crowd is still debating, which is exactly how the biggest moves begin. If you wait for comfort, you will buy higher. If you sell for comfort, you will sell too early. And if you treat every pullback as failure instead of structure, you'll repeat the cycle most people repeat. Exit, regret, chase, panic, repeat. The opportunity, if this plays out, is not a single day. It's a sequence of phases. Early phase, disbelief and underpositioning. Middle phase, acceptance and trend following. Late phase, mania and acceleration. And the final phase, volatility so sharp it feels unreal. The key is recognizing when the market shifts between phases, because the correct behavior changes with the phase. The reason this matters is simple. Generational moves don't announce themselves with clarity. They begin quietly, with ratios, flows, and mechanics changing under the surface. Then, one day, the market stops whispering and starts shouting. By the time it's shouting, the easy positioning is gone. Whatever happens next, the cleanest takeaway is this: don't anchor to one number. Anchor to structure. Structure is what moves markets. Structure is what breaks narratives. And when structure shifts, silver has a habit of moving faster than people think is possible.